My name is Fabio. I own Simplify with Mark. We started about 10 years ago. Before that, I was a financial planner and I was in banking. I think for us, the reason we started the business in all seriousness is we were working in banking and we see a lot of brokers out there being super transactional. And for us, is really, especially myself and Mark as well, can relate to it. I moved to Australia on my own when I was 18 from Brazil. And really property changed my life. And I really am very blessed to obviously work really hard, made mistakes, learn along the way. And for me, that's the important thing, is just share that knowledge and try and help people build wealth through property. I think we're very blessed that Australia is still a country that property can change your life and it really can help your wealth. So we're very passionate about that. That's the reason we started the business. When you look at other mortgage brokers, they can be a little bit more transactional. We don't do that. We want to try, it could be your first home and you want a roof over your head, or you want to use that as a mechanism to obviously retire early and replace your income or whatever that. So that's why we're here, and just to share those obviously experiences and see if we can add some value. Like honestly, it's a small group. I want you guys to be super comfortable, ask questions. And again, we're just trying to be as informative as we can. Thank you.
Thank you, Fabio. David.
Thanks, Fabio. My name's Dave. I'm the founder and director of Your Move Conveyancing. We look after all the legals for people that are looking to buy and sell property, all the boring stuff. We check over the contracts. Yeah. Boring but very important, we'll put it that way. Check over the contracts, make sure that you guys are all supported and there's no red flags in there before committing to the purchase, and then we work with you right through to the settlement. So traditionally what a lawyer would do in that process, that's what we take care of. Your Move Conveyancing was founded by me 11 years ago. I started my conveyancing career probably about 8 years before that. Similar to Fabio and Mark, I was seeing a lot of conveyancers and solicitors that were providing, I suppose, a bit of a subpar service, and just kind of seeing, clients, everyday people, just getting let down by, their trusted professionals in the process, and thought, why not just go out there and actually change the way in which services, particularly conveyancing services, are provided, and just do better, really. That's kind of where it all started from. So we now have 18 staff, look after pretty close to about 2,200 people every year buy and sell property. We focus predominantly, we focus only in New South Wales. The majority of our conveyancing work is based in sort of this area along North Shore, Northern Beaches, but we look after people that are buying and selling regional as well. A lot of our investor clients are purchasing regional areas, and we look after those types of clients in that process too. That's me.
Brilliant. Dave, thank you.
Thank you.
Amy.
Thank you.
Hello, everyone. My name's Amy. Nice to meet you all. Thank you very much for making the time today. I'm the accountant, and I am one of the founder of Private Wealth Solutions, which we are the accountant who help our clients to set up, the right structure when they make their big moves. And property is one of their, the biggest asset that you could have in your life, and it's very important before you purchase a property to make sure that you have the right structure for your investment, because it's like, having the right structure is like having a right pair of shoes. It helps you to go faster, go further without any painful blisters. And if you get the structure wrong, it's the tax could be the bad. the pain. So we see we have the passion to add value to our client to make sure that they don't make any mistake in their wealth creation journey, and they make every single decision as an informed decision, and then they plan ahead. The next generation think multi-generationally when they make investment decisions. So we've got multiple offices in Australia. Our main office is located in Crow's Nest. We've got a group of 15 employees, and we've got Vivian, Andrew, and myself. Me and Andrew, we work in the Sydney office, and Vivian has a Canberra office. So if you need, and also we specialise in self-managed super fund advice. We've got the license to help people set up self-managed super funds, and if any of you need any help in setting up a self-managed super fund or need any advice in terms of this, we can help you with that. Yeah, thank you. That's me.
Thank you, Amy.
Okay. John Halliday. I like to say they saved the best to last. I tell my family that because I'm the youngest of 11 children, which is ridiculous. And before you ask, Mum was Catholic and Dad was, I won't say. But I guess I'm here as the buyer's agent. I'm very passionate about property. I love working with like-minded people. Property's changed my life. I still get goosebumps when I talk about it because my upbringing was very different to what other people's was. And I've seen the impact that I've been able to have not only on my family to build generational wealth that I probably never thought was accessible, to then actually be able to do that for clients. I guess what I do differently and what I like to believe I bring is empathy and belief along with knowledge. And I think that there's a lot of people out there who make wrong decisions because of misinformation. I think social media is an amazing tool. I also think it's absolutely destructive in some ways. And most people who are delivering information have an ulterior motive, and it can get tremendously confusing. Like, I do this for a living, and I consider myself reasonably good at it. And even I sometimes watch some, podcasts, etc., and think to myself, really? And then I wake up and go, no. So I guess what it is that I try to bring is some clarity in what I consider to be a minefield of information. And I revert back to what one of my mentors, when I was 26, I was not doing very well. And fortunately I found this gentleman who went, you know what, there's something I can see in you. And I'm like, well, I'm glad you can, because I can't. And he sort of took me under his wing. And one of the things he taught me was, John, take all of the information that's available to you, sit back, put your common sense hat on, and if it makes sense, take action. And I've pretty much implemented that in my business, in my philosophy, and I'm fortunate enough to say that to date I haven't lost a cent in property, and we've been able to create amazing wealth for our clients. And we're now in a very fortunate position that we don't advertise, we only work from invitation only, and that's a lovely place to be. So hopefully I might be working with one or all of you in the near future. That's me.
Thank you, John. We will be running tonight's seminar where we will unpack 3 key case studies and hear what strategies our panel of experts will implement to help these people grow their wealth through property. So I do encourage after each case study questions, so please do not be shy. And we might start off with case study number 1. So first-time purchasers always love a stock photo. That is
They look very
the
happy.
most culturally diverse couple I've ever seen in my life. So, single applicant or young couple looking to build wealth. They may have just started their career, so they're now in full-time work. They may be living with their parents or in a share house. Without the burden of family expenses, they may have quite high disposable income. So, Fabio.
Sure.
For those that are starting off in their property journey, there is often the question over whether they should purchase an owner-occupied property first, or whether they and take advantage of some of the first home buyer benefits available out there, or should they go down the rent-vestor path? What are your thoughts on this?
I'll unpack this for you guys. So essentially what we're trying to do here is we run a scenario, because that's a question we get a lot. Like sometimes people, it's their first home. It's the first time they buy property. It's very scary. They don't know the process. Ultimately, we grew up with this ideology, I suppose, that you have to own your house. Like if you don't own your house, you're failing, there's something wrong. And I like to challenge that, especially in today's markets. Back in the day, I think it kind of made sense. And I'll use myself as an example. So when I bought my first apartment, I am very old. I don't look like, but when I bought my apartment, it was $395,000. It was in West Ryde.
You are old.
I am old. I am old. And it made sense, right? You get your government grant and you save your money on stamp duty, you get in. And the idea for us was I never wanted to live in West Ryde. I was living in Manly and I was having a great time. So essentially made that sacrifice, buy your own occupied, get that government grant and get into the market. And as soon as I could get out, which is 12 months on paper, for you to keep the grant, I moved out and rented, and that sort of catapulted my whole portfolio. I think that made sense at the time. I think we got to change as time goes by. Affordability becomes an issue in Sydney. So the grants now is like up to 800 that you sort of waive your stamp duty. So then we're in Sydney, like what can you get for 800 and what kind of return that property will bring to you? And then I'll pass that on to John. So my thought process is when you look at lending from a finance point of view and from a structure point of view, renting actually makes more sense if you're looking at building a portfolio. If you look at yourself and say, I just want to own a house, I just want to pay my mortgage, and that's where I'm going to be, makes sense, buy your owner occupied, save your money and get there. But if you're trying to build a portfolio in this day and age, I would definitely encourage you to consider renting for a while and then sort of put your money towards an investment property. Again, you're going to lose that 20 grand government grant, but again, I would love to have that conversation with John is like, what can you get for 600 in Sydney and what kind of growth you're going to get there? And if you go to Perth or if you go to Brisbane where you have immense growth, I think that 20 grand, you really won't even care that you actually don't get that grant. So for me, if I was a first time purchaser, if I rewind the clock and this is today, I would probably continue to rent and look at potentially build an investment portfolio and then eventually buy your dream home. Because I think we don't have to rush that, right? We all want that perfect home and we want the nice house. I think you can get there by doing things a little bit different, building a portfolio, building equity, maybe selling a couple of those or using equity to get to your dream home. I would delay that dream home and then build an investment portfolio.
Brilliant. Thank you, Fabio. I think that's a really good segue. John, if you want to sort of take over from there, I think there's... Yeah.
Look, this is something that I'm very passionate in. As you can imagine, youngest of 11 kids, I've got a couple of nieces and nephews. And rent vesting is the answer. Obviously, there's always emotion involved, and that's why with every single client, it has to be an individual conversation, an individual discussion. But if it's pure and simply financial, rent vesting is the key. I've got a current client who just bought their second property. They're 22. They came to me because they were looking to buy their owner-occupied property, and they were chasing the $20,000. And I just sat down with them and gave them a lot of information, and then asked them the question: what do you think makes more sense? They made the decision to rent vest. They bought a property in Brisbane 3 years ago, and that property's made them $300,000 in 3 years. Okay. They've now used that equity to buy their second property, which they just signed the contracts 2 days ago. And so to capture that $20,000 was going to cost them. And if we looked at the property that they would have bought as an owner-occupier, there's arguing, depending on who you ask, they've maybe made $10,000 or $20,000 in capital growth if they would have bought in the area they wanted to. So it's a matter, again, and it's not me telling people what they should do, it's just me giving people the information, and so then they can take all of the information in and make the right decision. And in this situation, they made the right decision, and we see that over and over again. And there's a conversation I don't have with my wife when we've been drinking, and just about 5 years ago, I predicted what was going to happen to the Brisbane market. And I suggested to my wife we sell our owner-occupied house and put forward what we could do if we sold our owner-occupied house. We have a substantial portfolio. No, you have to feel sorry for me. But this was just a specific scenario. And the decision not to sell the owner-occupied house, I've worked out, is 8 figures.
Oh.
Okay? So that's the difference between rent vesting and owning your own. Now, in that time, our owner-occupied house has grown by maybe $400,000. And the difference was astronomical. But emotion plays a role, and it was either get divorced and do that or stay married and have a nice portfolio. So yeah, look, my belief is, when is the right time to buy property? The answer is always exactly the same. The answer is now. The question is where. And that's what I believe my job is to educate you enough to be able to make the right decision and capture, because if you buy a property, everybody goes, well, if I buy a property here, it'll be twice as much in 10 years' time, which is pretty much accurate. But if you buy a property and you get substantial capital growth in the first 2 to 3 years, it just accelerates the whole process so much faster. Example, Jake, who bought that property in Brisbane. Do you know what I mean? Like, he's now $300,000 wealthier. He's in the position of buying his second investment property, and it's changed his life dramatically. And now they're making the decision to rent vest. And even in I did this just quickly because I did get a heads up of what the question was going to be. Don't tell anybody. But I just did it on my own home. And look, my own home, I bought as an investment, really. Don't ever tell my wife that, but it's a double block and it's in a good location. And it's probably worth $2.5 million, okay, as it is as a house. If I was to rent that house, it'd cost me $850 a week. If I took an 80% loan on that house, it cost me $1,900 a week. Okay? It's like, and then you do that, that destroys your ability to be able to then go and invest. Whereas I can live where I need to live, and I've got an extra $1,000 a week to go and play with. So I hope that answers the question.
It's a great example.
So I could talk all night.
Yeah.
Does that work, or is it plastic? Is it foam?
Yeah, with the idea of rent vesting, I think it's really important to point out, which Fabio has already touched upon, and John as well. What it does give you the ability to do is we live in a tax system that's actually quite, it facilitates property investment quite a bit. And a big part of that is negative gearing, and lenders take that into account, which then increases your borrowing capacity, which then allows you to continue to build your property portfolio as a result. All things tax and negative gearing, I think we should go to Amy, and you can give us a bit of a rundown on negative gearing and how it works.
Yeah, sure. So negative gearing is when you've got your rental property, you can actually claim various tax deductions on the rental property expenses. For example, you can claim the interest, the depreciation on the building work, and also all other rental expenses. And when the rental expenses exceed your rental income, the excess amount, you can use that as a tax deduction to reduce your other assessable income, for example, salary income, and you get a tax refund from the tax office at the end of the year. You use that tax refund to put it towards your offset account, and it helps you to pay off your mortgage faster. And because you are getting a tax refund at the end of the year, you can actually contact your employer to reduce your PAYG withholding on your wage so that you can get the tax refund earlier throughout the year, and so that you can access that benefit early and you put it towards your offset account. It helps you to pay off your loan much faster. Yep.
Brilliant. All right. Yeah, please. Yeah, there's some real
You're
stuff
very
there.
knowledgeable. I'm going to break it down. So in Australia, we're very fortunate that if it's a system that the more properties you own, the less tax you pay. It's kind of odd, but it is the way it is. That's why people love property. What Amy was trying to obviously explain, tax refund. So in Australia, you can actually go to your employer and you do an average, and again, I'm not getting into it because Andrew's looking at me like, don't talk about tax. But if you know on average what you're going to get as a refund, you can go to your employer and then you get that back monthly as opposed to waiting the full year. So the good thing about property in Australia is it's a weird shift, like, because you literally look forward to doing your taxes when you have investment properties. Not you, because you sell them, but you get that refund back. So I think when you're looking at investment property, you look at your cash flow and you look at obviously the rent minus the expenses, and that can be a little bit heavy, but you always have to take into account everything that you can claim. You can claim depreciation, so you can claim, you do a depreciation report on your property, and you can claim like that asset depreciating in value, so that comes off your taxes. You can do all your interest, all your expenses, everything that you spend money on that property, you can claim that back. So when you look at your taxes, and let's say you earn 100 grand and you're supposed to pay X, they take that loss out of your income and then they refund the difference. So again, that's a good thing about investment property in Australia, and that's why I think investing in Australia it's quite lucrative, because you definitely get that benefit moving forward, which allows you to then obviously use that to pay your mortgage a little bit faster or get ready for the next one. So I just thought I would jump in there.
Absolutely. Yep. I think where it really does make a difference, and it's something to always be mindful of, is although the property is negative cash flow, so it's costing you out of your pocket, the thing that really is the money maker is the capital growth in the property. That's the sort of stuff that John is able to find, locate, and that cash flow helps you out with the negative gearing, but we always want, as far as building wealth goes, we want that capital growth in the property. Scenario 2, so you've owned your property for a while and thinking, what is the next step? So a really common scenario that we see is with a property owner is whether they might be a single applicant, couple or family, and they've done really well. They've had their property for a little while and now they're sitting on equity and they want to take the next step in growing their wealth. They might be quite set in their career. In some cases, they might be in those peak income years. Their wealth base is strong and it's grown because they've had their property for a while and they're now on top of their expenses. So Fabio, I might throw it to yourself again. Can you please let me know how you would approach this type of client and any key strategies that you would implement to help maximize your opportunities? I think really the key one there is, if we go to this one here, that's really...
Does anyone have property here? Do you own any property? Yep, yes. So essentially, what this scenario is really trying to explain to you guys is just how equity works. So essentially, you would have a property, if your property is in Sydney or Brisbane or Perth. What's the hotspot, mate? You got to tell us.
Perth and Brisbane are both hotspots at the moment.
There we go.
But the question is, do you want to buy after you've had social proof? Or
True.
Do you want to buy before?
You'll be the first one. We'll cover that. I think the good thing about property in Australia is equity. And then again, is just unlocking the equity and what can you do with it. Again, you can invest in property or you can invest in shares, but it's definitely a wealth generating tool. So what we're trying to illustrate here is just a very simple scenario. You have a house, it's worth about $1 million, and you owe $500,000 to the bank, which means you have potential equity that you can unlock. And then what we're trying here in this scenario is normally at Simplify, we like to keep everything at 80%, because does anyone understand 80%, 90% mortgage insurance? Just want to make sure. So we like to keep everything at 80%. It keeps everything cheaper, nice rates. We don't have to pay mortgage insurance. So essentially, you can unlock up to $300,000, provided your borrowing capacity allows you to. And that $300,000 you can go and use to invest in anything else. It could be shares, you could buy other properties, and that becomes, in the eyes of the government, and Amy will back me up here, tax deductible, so you can claim tax on that. So now your home, it could be used as a vehicle to potentially allow you to continue and grow wealth. That's essentially what we're trying to do about equity.
Brilliant.
So the second slide is just to sort of visualize that. So let's say you got $1 million house, you owe $500,000. A lot of people work really hard and they pay their mortgage, but they don't know that they can tap into that at any time. So essentially, yes, if you remember from slide 1, you could have up to 300, but you don't have to. So we just use a very basic scenario here, say, hey, let's say I met John and he's amazing and he recommended a 500,000, is that possible, 500 these days?
I just bought a property today for 585. So
Perfect.
Okay.
My slide is not that old. So you meet John and you're like, okay, what can I do with $500,000? So essentially what you can do is use your property as opposed to sitting at home saving $120,000 post-tax, so you got to pay tax, and then put your money aside, and then earn interest at ING accounts, and then pay tax to the government. So what you can do is tap into your equity, use about $120,000. That is your 20% plus cost of a $500,000 property. So I suppose from that scenario, we're just trying to really uncover that a lot of people have that equity there. And to simplify what we do, obviously we're mortgage brokers. So what we can do is we can value your property with different lenders, because that's another topic, right? So let's say you're with the CBA and you go in your app and it says your house is worth $900,000. I guarantee you, if you go around and ask different lenders to value that property, you can get a little bit more, you can get a little bit less. So what we can do is just look at your property, have a look at obviously your lender, compare all the lenders' valuations, and trying to extract as much as we can, and then we can sort of start building your portfolio moving forward. So out of the 300, we can use 120 for this one, 120 for the next one, and so on and so forth. I suppose that's the key here, is just remember your home or investment property can be the key to unlock you some wealth moving forward.
Brilliant. A debate that often rages amongst investors is P&I versus interest only. What are your thoughts on that, Fabio?
That's a terrible question. Okay, so let's unpack that.
Yep.
So if you have an investment property, you can do two things in Australia. You can pay principal and interest, so that means you're paying the mortgage down, you're paying the principal down, or you can do interest only. I believe in both. That's a very
Fence
political.
sitter. Okay.
No, I do believe in both. And the way we sort of structure with Simplify, we're trying to help our clients. Interest only makes sense at the beginning of your journey, right? So when you buy 1, 2, 3, 4 properties, I know it's a bit scary that you're not paying the principal down, but the game here is to build your wealth and to make it easy. So you don't have to, when we go through situations like that, the rates go up and down and you sort of panic. You want to control that cash flow yourself, right? So what we do is first 2, 3, 4, we normally do interest only. And the reason we do that is because it's a lot easier to maintain your portfolio if things go wrong. Like you have 4 properties, things will go wrong. Like people will move out, you have a tenant that broke a stove or whatever. So when you're interest only, even though you're not paying the principal, you're actually controlling the cash flow yourself. Once we get to a point that you know where you want to be, because a lot of the times we have that conversation with clients and say, okay, you're buying property, what for? Is that for retirement? Do I want to replace an income? And a lot of times people say, hey, I want my wife to stop working, I want $100,000 in passive income. So when you get to property number 3 these days, you have $100,000 in income, in rent. But again, it's not passive income because you got to pay the mortgage. So that's when at that situation we go, all right, let's start doing P&I on one of them and start reducing that debt to eventually replace, because the income is just an income that you still got to pay the mortgage. So the answer to that is I believe in both. I think the beginning of the strategy, when you're accumulating property, you go interest only, it will be easier to hold. And then as you're going through that journey, and you obviously talk to your broker or your bank or your financial advisor, your accountant, that you get to a point that you start moving that to P&I so you can sort of extinguish that debt and enjoy, obviously, the passive income.
Great. Thank you very much. Now, a very related topic to that is the idea of debt recycling. Amy, can you talk us through that and the importance of having a knowledge of that in your property portfolio?
Yeah, sure. So the debt recycling is, for example, on that flow chart, say that you've got your principal place of residence and you've got your home loan against that property. As you use your salary to continuously pay down your home loan up to a point that you have some equity, which is Fabio has discussed before. When you've got some access to some equity, you can actually refinance, do a redraw from the bank. Is that right, Fabio? Yeah. And then you use that redraw to buy a investment property. And because you are using that loan to buy an investment property, that loan becomes a tax deductible loan. And any interest that incurred in that investment loan becomes tax deductible, and you use that rental income generated from the investment property to pay down your home loan, which is the the non-deductible loan. So essentially, you are converting non-deductible loan to a tax-deductible loan, and you keep doing this until your non-deductible loan balance becomes really low, and then most of your loan is become deductible. So the benefit of doing this is the tax benefit. Say if eventually your investment loan becomes $1 million and then the interest rate is 6% per year, you're looking at around $30,000 of tax refund per year, and that's a significant tax saving, and you can put it towards your offset account. And if you keep, you put it every year and put it into your offset account for 30 years, you get $700,000 of saving in interest for your overall share portfolio. And the tax saving, the tax refund is like an additional benefit that you get for your property portfolio, in addition to any other, growth in your investment property. So, and if you do that, also your loan term will be shortened by 11 years. Basically, you pay off your loan 11 years earlier.
Yeah.
So with this benefit of tax.
Yeah, and I think what's really important is us as brokers, we always love speaking to accountants and making sure that we set up the right team around all of you to make sure that you're getting the right advice, because the structure of a loan, we want to get it right on day one, but it's also an ongoing thing. So over time, we'll be accessing equity, we might be structuring things in a certain way. We always want to make sure that we're working broker and accountant hand in hand to get you the best outcome possible. Depreciation, that's also an important term as you build a property portfolio. Amy?
Yeah, that's right. So when we talk to our client, a lot of people actually don't know that they can claim a tax deduction on the purchase of their property. So basically, you can claim a tax deduction on the depreciation of the building work. And basically, what you need to do is you just need to get a depreciation schedule from the quantity surveyors. It's not very expensive, like it's up for $500, $600. And then, for example, if your building cost, typical building cost $500,000, you can actually access to $6,000 per year of additional tax refund on your tax return. And to use that $6,000 of tax refund, you put it towards your offset account for 30 years. The interest saving you can achieve is $260,000 over 30 years, and you pay off your loan 4 years faster than before. So, yeah.
Does this only apply to investment property?
Yeah, it only applies to investment property because you can only claim a tax deduction for your investment property. Thank you.
Brilliant. All right, beautiful house, which is a nice segue to David and the due diligence that is very, very important when purchasing property and building your portfolio. David, do you want to run me through?
Oh, here I go to destroy your dreams.
Do never mind.
That's right.
But can you take us through what is
Yeah.
that like? Have you had a situation? Sorry, I'm going off schedule here.
No, of course. Go for it.
Like the importance of having someone really going through the contract. Like,
Yeah.
have you seen some pitfalls of people that didn't understand, like their neighbor's property was crossing the boundaries? Like that's something that I think it's really important to share, and it's developments next to the property. Like
There are
take
so
us-
many.
Does everyone know
That's-
what a conveyancer do? Just making sure. There we go.
Yeah.
I think
We-
we should explain.
Yeah. Well, sort of what I touched on a bit earlier, we look after all the legal requirements in the buying and selling of real estate. But importantly, on the purchase side, one of our critical jobs at the very beginning is to review the contract for the sale of the property. So in New South Wales, the owners are required to disclose various documents in the contract. They're called the prescribed documents. Things like how the property's owned, where the sewer main runs, if there's any easements or covenants that might affect the title, and then a bit about what it is that the owner is selling and expectations around settlement, and if there's any tenants, disclosing those types of potential pitfalls as well. So all of that is bundled up into the contract. We review that around the time that you're considering to make an offer, and tell you all the reasons why you may want to reconsider doing that. No, I will say in the vast majority of cases, the contracts, especially in New South Wales, are pretty clean. There's not normally things that can't be worked around, but I'll give you an example of one that couldn't be worked around. So this is a semi near where the WestConnex has just been opened up, sort of around the Balmain area.
So this is a real example.
It is, yeah. So, so these clients of ours, they had seen the property a couple of times. Obviously, the advertising from the agent was, very promising. Property needed a little bit of work, but they were open to doing that. The property was actually owned by the Department of Roads, or whatever they're called now. So they acquired all of these terraces thinking that they were going to need to demolish them as part of the project, and they didn't end up needing to do that. So they've now started the process of selling off these terraces. But you can see there's a gate there on the left-hand side of the property. That's actually on the title of the property that was being sold. And on the face of it, it looks like a nice gate that goes down the side of the house. I think the next slide, you can see there, it just opens up into the backyard. They've done a nice job to put some Afro turf down the bottom there, green it up a little bit. And, on the face of it, it looks like, they own that part of the land. And technically they do. However, the next slide there, you can see that I've highlighted in yellow, is a right-of-way. So it's a right-of-footway that allows all of those owners perpetual rights all the way up the back of the lane there, to legally be able to access the backyard of this property.
So everyone,
Yeah.
That's right.
everyone that
Yeah.
lives here can use that to get to the back of their house.
Yeah.
And they can't
Yeah.
stop them.
No.
Okay, that's
So,
great.
so that was a very recent case. It was only a couple of weeks ago that came across our desk. There are avenues to extinguish right-of-ways, but you have to. It's a process, and it requires. It will eventually require court intervention, and it's a whole thing. So when you're looking at it from the buyer, is this something that we want to tackle as an owner, having to deal with all of the issues that come with extinguishing this right-of-way? Probably not. Yeah.
Can I ask a question here, David?
Yeah.
I'm just guessing that the selling agent didn't divulge that information.
You are spot on. Yeah.
You would not
Yeah.
believe that.
No, and that's the thing, and without sort of going too much into all the reasons why we love and loathe our selling agent friends, at the end of the day, they act for the owner.
Yeah.
So they're contracted to the owner to sell the property on the best terms for the best price. So yes, there are some things that they are legally obliged to disclose to purchasers if they reasonably believe that it's going to impact what a reasonable person would pay for the property. You would say that is definitely one of them. But it's kind of like a see no evil, hear no evil thing. They ask limited questions from the owners to avoid having to broach issues like this, and leave it up to the legal guys in the background to figure it all out and make that advice to their clients. Yeah.
In this case, did the selling agent know about this?
We didn't get that far.
Okay.
So the buyer, he just said, no,
If
I'm
the
not going
buyer's
to.
disclose this. The selling agents aren't doing the work that you're doing, so potentially they didn't know this, right?
They potentially didn't know. Yeah,
Sure
that's
they
right.
didn't know.
Yeah.
Actually,
So look,
it's a volume game, just sell.
Exactly, yeah, and it is like a hear no evil thing as well. They, you know, like I said, they deliberately ask very limited questions to avoid having to go down that disclosure route.
Liable, let's say the purchaser went through and bought the property.
Yeah.
Who's liable, the owner or the agent, for not disclosing that?
Well, the truth be known, we would be as the conveyancers acting on their behalf to provide legal advice on the documents that are disclosed. So the vendor would rightly say, hey, it's disclosed in the contract, hands are clean.
Okay.
Yeah, yeah. So of course, you know, there's a lot of weight on our shoulders as the kind of the last pillar of getting towards that point where you're putting pen to paper on a significant asset, and of course you've got other stakeholders and, you know, pressures that are being put on by, you know, internally with yourself, your family to get, get your dream home bought. Obviously, the selling agent, they're no doubt calling you asking why you haven't signed a contract when your offer was accepted 5 minutes ago, all those sorts of things. And so that's where we kind of come in and say, it's probably going to all be okay, but let's just slow down a little bit so that, you know, we're making sure that any of these types of issues are resolved before waking up to a horrible nightmare the next day.
And it's not always the evil selling agent.
Yeah.
It could be that they just don't know. But
Yeah,
that's why David's
that's right.
role is so important.
Yeah.
Because somebody's got to find it.
Yeah.
Because you won't.
Yeah.
Average purchaser won't find it. So.
Yeah.
Brilliant. Thank you, David. Great example there.
No, thank you.
Might throw over to John. Yeah, sorry, yeah.
Yeah.
Every property that's sold in New South Wales, do you have to have a conveyancer? Or is it
Yeah, conveyancer as solicitor. Look, up until probably about 10 years ago, you could technically do it yourself.
Yeah.
There's obviously many reasons why you may or may not want to do that. The cost of a conveyancer, is roughly about $2,000 in the scheme of going through the process of learning what needs to be done. Pitfalls of when deadlines aren't met and all those sorts of things can be quite costly. Nowadays, it's not, you can't actually do it on your own because all the settlements happen electronically on a platform, PEXA, which some of you may have heard about. You have to be an authorised subscriber to be able to transact property on that platform, and the only two avenues to be able to do that are through a licensed conveyancer or a solicitor.
I might actually jump to scenario 3, John. Sorry, I will come back to you if that's okay. Yeah.
No problems at all.
And the reason why is there's a great deal to unpack in that.
The flicker died.
Oh,
You're going to be made by the same guy who made my
how do I do
remote
this?
control for my garage.
Can you help me? Okay.
Good.
All right.
Getting out this
Brilliant.
morning.
So, there's a lot to unpack with this last scenario, scenario 3. So, property investors looking to take it to the next level. Once again, stock images are doing their trick tonight. This is a really exciting part of the night, as this is where we really look to push the boundaries and uncover what the top property investors do. To give you some context, only 5% of property investors have 3 or more properties, and only 2% of property investors have 4 or more properties. There will be some complex concepts that we discuss here, so I encourage you to take down notes that we can certainly discuss during the Q&A. So if we sort of think about this client and their sort of what they look like, they might have bought or sold several properties in the past. They may have been able to manage the cash flow of a multi-property portfolio. They would have seen a few market cycles pass. And they would have done well out of property, but also they would have seen some tougher times, vacancy rates, property, maybe some damages to properties that they needed to fix, urgent repairs, and what say you. So Fabio, looking at this type of scenario, as an expert that has helped thousands of people finance investment properties, I might throw a few terms at you and would love to hear your thoughts on them specifically in the context, a few terms. So non-bank lenders and how they sit
Do you
in
want
this
to
type
just
of...
flick to the next slide and
Oh, yeah.
we'll take you through
That's right.
that?
Yep, I'll go there first, yes.
That's a topic I really love because I think, like John mentioned before, social media can be a bit right or wrong, just influencing people's decisions. And then you go along and you watch these people like how do they get to 10 properties and 15 properties? So there's a strategy behind it. Again, when you're looking at the amount that you can borrow, is your income, expenses, the banks are all the same. So what we can do sometimes is to find a way to allow you to continue to grow that portfolio. At Simplify, we're very passionate about finding ways to continue to grow your portfolio. A lot of our clients, they go to a bank, they go to your bank. I have a loan with CBA, I have 2 properties with CBA. Hey CBA, how much can I borrow? And they say 300,000, and you're like, oh, I can't go anymore, and then I stop. So a lot of times we get clients coming to us and say, hey, what can we do different? What did we do at the beginning that was wrong? How can you allow us to continue to grow your wealth? So what we normally do here is, I think if we explain the example, I think it will make more sense. So this client, whatever his name is at the time, I can't disclose it. So he came to us, he has a property in Ryde, and then he had a property in Newcastle. And essentially, he went to his bank and say, I want to continue to buy my 3rd or 4th property. And the bank says, listen, you can't service anymore, have a great day. The way we do things here is you look at the overall portfolio, and what we can do to sort of look at the numbers, we can start playing with lenders. So when you're a mortgage broker, you have access to, I would say, 50 banks. In Australia, if you're a deposit-taking institution, that means you take deposits, so you have a savings account, a term deposit, you consider a bank. We have other institutions that are still regulated by ASIC, they call non-bank lenders, which a lot of times people don't understand, and the fear of using them becomes, oh, I don't want to do this because, back in the day, you only go to these guys if you really need it or if you have a bad credit. It's no longer the case. So essentially what these guys do is the way they assess your borrowing capacity is very different to the banks. So they tend to be a little bit more flexible into allowing you to continue to grow your portfolio. So sometimes you go to a smaller bank, you pay a higher interest, and then again, throwing back to John is, what's that trade-off, right? So instead of getting my loan at 6.5 and then say, no, I can't buy a property, should I go and pay 799, but then allows you to get the next property? So what we do at Simplify, we try to focus on 2 things. We look at all lenders possible. We look at smaller lenders to say we can maximize your borrowing capacity, but we also look at the structure. And this scenario is really key because someone that came to us and say, hey, I have 2 properties, I want to get to a 3rd. CBA said no. I keep saying CBA, but it's just, I feel like I'm slang. Yeah. NAB said no. When we ran the numbers, he could go one more with a non-bank lender. But what we did is, as opposed to say, hey, what's the goal here? He goes, listen, I want to build passive income, which is that figure right there. So essentially, he wanted to replace his income eventually. So for us, what we did is what a lot of savvy investors do is we create a trust. So in Australia, if you create a trust with a corporate trustee, you can buy property inside a company. When you do that, you essentially, if that company, provided the accountant is happy to confirm that the loan is being paid off by the rent, essentially what I can do is I can compartmentalize that debt. So I put that property inside a trust, and then when I go to property number 4, this lender here will ignore this loan. So by changing this structure, just by putting a property inside a trust with a corporate trustee, it has to be a company, you essentially compartmentalize that debt, and then it allows you to ignore that debt when you go for the next purchase. So for someone that has the ability to buy no property with a big bank to the ability of buying one more with a smaller bank, we managed to get 2 more by just putting the next one in a trust. So we compartmentalize that debt, we put that into a trust, and then he allows us to get to the next one. That, we're talking about $1 million in property here. Just by simply changing the structure and make sure, obviously, we understand what they're trying to achieve. And then again, we have to make those decisions very carefully. It's important you have a great buyer's agent that allows you to maximize the rent to make sure, obviously, with a higher interest rate, you can still hold that portfolio. I think that's one example to sort of how do we, when you look at online and people are like, how do these people get to 5, 6, 7 properties? Those are the things that they do a little bit different that the everyday Australian don't. Again, there's pitfalls, and I'll leave it to Amy to go all the tax deductions and all that. But does that make sense, guys? Does that really puts into perspective?
A bit hard to explain in a TikTok.
No, I couldn't do that. I got to start a TikTok account.
Yeah. Might go that.
I think it's a good segue.
Yes, please, yeah.
Oh, sure. We
Can
go
you
back.
back?
We're all doing them. Yeah.
Why don't you just put your assets to the trust at like property number 2?
Because when I met him, he already had that. Yeah.
You just wait until like.
So essentially, in this scenario, right, this customer came to us and he already owned those 2 properties and he was told he can't buy anymore. But absolutely, you're right. So if we get someone at the beginning of their journey and it's really about where do you want to go? Because again, buying property can be addictive. It's true. Because honestly, we have customers that they come to you and say, hey, I want $150,000 in income. And then when we get to property 10, they're already earning $250 in income. They go, I want to buy one more. I'm like, why? You're already there. So once you understand the goal, if we get someone at the beginning of the journey, absolutely. Because if someone comes to us and say, this is my income today, and I want to get to 5 properties, then absolutely, property number 2, probably in a trust, and then we go individual, and then we go trust, and then we go individual. But that's a great question. I think it's really, in this particular scenario, I just met him here because he came to us saying, hey, I can't buy any more. But we managed to get him 2 more, which is obviously a substantial impact on their wealth.
So when on property number 4,
Yep.
ignoring the trust, what was the question of serviceability of that?
Yeah, so we actually, that debt doesn't exist to this bank because it's all within that trust. It's compartmentalized within that company. They won't even take into account. So they ignore the rent, they ignore the debt, which then allows us to, again, using a smaller bank, to get you to that property number 4. If we didn't do that, that's where he ends. He went for 3, which again is still a great outcome, but it doesn't really align to what he was trying to do. Does that make sense? Yeah.
This might be a bit extreme, but
No?
with that, like kind of concept going on there.
Yep.
Does it mean that technically you could do that with first, second, third property? So
You can keep going.
like what do you?
But it is a great question because if you go on Instagram and then people say you can buy property forever, that's not the case, okay? So what happens here, you have to be super diligent which lenders you go with. And I'll give you an example. Some lenders, they tend to ignore debts within companies. Some lenders don't. So let's say Simplify, for example. Mark likes to drive a nice car. He has a car in here. There's a debt inside the company. We have to disclose that with most lenders. Some lenders will ignore all the debts inside the business. As long as the business is profitable, they don't care. So it's very important that we go and put this in a trust, but it's not an infinity thing because we're going to run out of banks that ignores debts within company. But that's a really good question because that's a really... There's people selling books that you can go and buy a property forever by doing that, and that's not the case.
Right. So does that mean that technically doing that you could actually maximize how many properties you can get?
Absolutely.
early on, right?
Yes. So if you go early, then you can compartmentalize all those debts and then go into an individual name. Again, there's tax implications. When you're doing negative gearing, which Amy explained before, you can't do it in your personal name because the company owns that property. So there are obviously tricks to the trade. There's a trade-off. But to your point, if you start that process early, you can go a lot farther.
Right. So you could technically start it for your first property.
Absolutely, you can do it any time. Yeah. So the deposit's there, but if you're ready to go, you can start that process early. But again, for us here is really understand that where are we trying to go? Because if you come to me and say, I want 10, let's go early. Right. But if you say 4, then I look at your income, look at your expenses, and we can make that decision straight away. It is cheaper to have a property in your individual name because not many banks like trusts, so they tend to charge a little bit more. So sometimes it's not wise to go too early because you want to save some money at the beginning. Yeah. It's really based on what is the end goal? What are we trying to do? And what we do here is we literally map that out for you. So you came to us and say, hey, this is my income today. We try and run numbers as accurate as you can because things change. But you tell me this is my salary, these are my expenses, I want to get to X, and we can map that out for you and then run all the numbers based on what your numbers are off today, obviously, because we don't know what's happening, and then sort of get you to that portfolio. We can do that.
So technically, I guess the earlier style is kind of better, like getting that information.
Absolutely. And then again, even if you're buying your first owner-occupied, it's always good to really understand why you're doing it. And regardless if you're buying your first property as an investment or an owner-occupied, just tell us where do you want to be. So the good thing about having a broker with you is we're not a bank, right? Like it's our business. We're not going anywhere. So we know you. You come to us and say, hey, this is where I am now. This is where I want to be. And we'll remind you. It's annoying, but I'll call you. I'll be like, come on, man. You said you want to get to this third property. So that's essentially the earlier in the journey. And that's the thing that we really like to be very proactive about. A lot of people, there's this fear of like, I can't afford property. There's no way I'm not going to buy one. And that's not true. I was going to swear now, but anyway. Because like a lot of our clients are on very like reasonable incomes, 30, 40 grand in savings, and they can't get there. It's really just have that conversation early. And if you're not ready now, we will show you when to get ready, right? We actually can tell you and say, hey, if you save X, you're going to get there. Because imagine saving money for the sake of saving money. You're just putting money aside and then one day I'm going to buy a house. That's disheartening and that's exhausting. But if I give you a map and say, hey, if you get to 60 grand, we're going to get you there, then it's a lot more objective, right? And you go, hey, I'm trying to get to that figure. So as early as you can in the process, if you have no savings, we do not care. It's for us is really about having that conversation, putting a plan together. Because again, we're not going anywhere. We're all going to pay our mortgages and kids, and we're always here to sort of help you through that journey. Any other questions? Because I think this has sparked a few.
Yeah, it has, right? Yeah.
But yeah, that's sort of, so we have what we call like a wealth club. So again, I keep talking about a lot of brokers, but again, it is what it is. So for us is really, we created a club. So if someone says, listen, I'm serious about property, I want to get there. It's a lot of work that goes for us to run those numbers. So we created what we call a wealth club. And as soon as you're in, we just do those reviews every year. And we sort of make sure you're accountable for. So we'll map you out, put all the strategy in place. We'll keep revaluing your properties along the way. We'll catch up with you once a year and say, hey, how are we going? We can help you with the budget. We can help you with what Amy said, debt recycling, which is a great strategy. If you have an owner-occupied and you have a debt there that you can't claim tax, the ability of recycling that and reducing that debt to increase the amount of tax that you can claim, it's very, very powerful. So a lot of times, I know we've been talking about reinvesting, but we have clients that have an owner-occupied property that we actually made possible for them to reduce their debt and save thousands in interest. Because by having investment properties, you can allocate that tax refund that you're going to get, park that into the offset account, which is your non-deductible debt, which is your home, and allows you to pay that loan a lot faster. So again, there's so many strategies we can put in place. So then we created that. So it kind of helps our clients sort of achieve that. But it's not something compulsory. If you want to, again, we're here to help people buy their first property. If you want to develop, I don't know, we're funding a $46 million development. We're doing that as well. So we do from mums and dads trying to get to their first home, to someone trying to get to their first property, to someone wanting to build a portfolio. We always will love to help you in any way.
Brilliant, Fabio. Thank
Next
you.
slide.
Next slide.
Oh,
This
there
is
we go.
this is now a really great crossover between accounting and lending. So Fabio has given us a really great background in the lending side of things. But Amy, did you want to speak to us about some of the structures that you can use to acquire property?
Yeah, sure. So there are many options that you can put the name on that contract. You can invest your property in a company name, in a trust name, in your own personal name, or in your self-managed super fund name. And the factors that actually affect your decision is the 4 factors you need to consider. Whether my structure protects my asset, and whether this structure is tax efficient, and what if that I pass away? What happens to my asset? Does the structure help me to pass on my wealth to the next generation? And whether there is any flexibility in terms of in the future, if anything changes, if there is any flexibility in the structure. So many of our clients, they think multi-generationally, like when they set up the structure, they need to think about their grandkids, because when they become old, their kids probably already at retirement age, and it's really their grandkids that benefit from the wealth. So you need to think really ahead about who's really benefiting the wealth that you create. So investing a property in a company, we actually discussed that in the last month investor night, so I won't go into very detail in this session. So today I'll mainly focus on investing in trust name and also in self-managed super fund name. So first of all, investing property in a trust, I think it will be easier if we go through like a flowchart and example. So we've got Bob and Mary. They have a trading business. Bob is a director of that trading company. And now they wanted to buy a property. They set up a discretionary trust with a corporate trustee. And they put the discretionary trust as the trustee name on the purchase contract. And the reason, the good thing of having a trust holding the property is that it creates really good flexibility of distributing income to a specific beneficiary. For example, when the rent income is received by the discretionary trust, the trustee has the complete discretion of choosing which beneficiary that the trust will pay the rent income to. For example, if there is a low income earner in the family, the trustee can actually allocate that income to the low income earner to make the tax planning very tax efficient. And the other good thing is that if you are investing in high growth asset, for example, the value goes up a lot and the gain is capital in nature, putting the asset in the trust name actually gives you the access to the 50% capital gain discount if you hold it for more than 12 months. And also when you sell the property, you've got the capital gain, it is discounted, it can further be split among the family group. It can be split, the husband and wife, depending on their income for that particular year. So it really provides great flexibility when it comes down to income splitting. So that it can, like every year, we can sit down with the client to decide, okay, who receives how much before 30 June to make your structure really tax effective. And this structure is also very good with asset protection. The reason for that is to have a corporate trustee, it really separates the asset held in the trust with Bob and Mary's personal assets. So Bob is a business owner and he's the director of that trading company. He might be more exposed to business risk. So if he gets sued, the asset actually locates in the discretionary trust is a separate asset to Bob's personal asset. So as long as that we have the appointor set up correctly. And the appointor is really the person who takes control the trust. The appointor has the power to remove or appoint new trustees, which manages the trust. So and when we work with our client, we always make the suggestion that they should have at least 2 appointors and maybe an independent appointor as well, just because if, one of them becomes bankrupt, they're not the only one controlling the trust, and they could actually argue that, the trust asset, they don't control it, so that, it's not accessed by the trustee of the bankrupt. So it gives great asset protection. So when you go through the process of setting up trust, these decisions are very important, and you need to be very careful of, who you put down as the appointor, whether you're going to be, only having one appointor, you control the trust, or you want to have both of you have being the appointor of you, or if you want to have, an independent appointor as well to give it to, extra protection of the trust asset. So, and the other great thing about this structure is also, if Bob or Mary passes away, this structure still continues. The asset still stays in the trust. It doesn't need to be sold, and because they are the beneficiary of the trust. If beneficiary pass away, the trust still continues, and their kids still can continuously benefit from the income of that trust. So it's a really great tool to pass on wealth to the next generation, and possibly to the next generation as well. So, and the only thing that you need to be careful about holding a property in a trust is the land tax. So if we can go to the next slide, please. So land tax wise, if you hold a property in a trust name, some of the Australian states actually penalise the property owners or trust owners to be holding property. For example, in New South Wales and South Australia, you can see that the trust actually pays a premium in land tax if you hold it in the trust name. But as long as you're not investing in these states, like other states, for example, ACT, Queensland, WA, Tasmania, and Northern Territory, it's fine. It's like holding the property in a trust name is actually a very, very good structure. It's a very tax-effective structure, and it provides great flexibility. So so when you buy your property, make sure that you look at which state that you are buying, and it's a great, you need to look at it and make sure that you're not paying too much land tax. Yeah.
Thank you, Amy. I know you put together some SMSF stuff, but I'm just in the interest of time, I might go over to John. What we normally find as the portfolio grows is cash flow can sometimes come under some constraints, and we need to sort of find creative ways to be able to continue to generate the cash flow needed to hold the properties. What are your sort of thoughts and solutions in regards to that?
Look, this is an example. I hope the customer doesn't mind me showing because it's mine. I don't like to show other people's things, so it's my one. But here's an example of being able to generate great cash flow. And obviously I'm a little bit further along in my portfolio. I'm in the industry. I have a bit of a different appetite for risk, etc. And that's why it's all individual. And what advice suits one person doesn't necessarily suit another person. But in this situation, that was originally a beautiful old Queenslander. It's up on a hill, 5 k's from Brisbane. From that little balcony out the front there, you can see the whole of Brisbane City, which is lovely. It was just an original Queenslander on a 607 square metre block of land, okay? It's now 4 incomes. So I lifted that Queenslander, brought it forward, moved it to the side, counter-levered, as you can see there's big beams there, built in underneath it, and then I've built 2 townhouses or a duplex in the backyard, okay? I don't mind, again, the customer probably won't mind me talking figures, but just to give you a bit of an idea, the whole thing, including acquisition, holding costs, everything, has cost me $2.6 million, okay? It's just being I should receive the keys, should have received them the day that the tornado hit, or the cyclone hit, but we've had a little bit of a delay. I'll get the keys this week. The 2 back townhouses will run out for $900 each, okay, between $875 and $900. The front house will rent out for $1,000, okay? So that's generating me probably 5.5%, 6% yield. But return on investment is about 175%. Okay? The equity that I can release from that is substantial. But then again, what I've also done is, what we try to do is see holes in the market. There's a lot of people out there doing granny flats, which work perfectly, by the way, but there's a lot of people out there doing it. So the market's very busy, so it's harder to find the bargains. A lot of big developers out there developing. This is a little hole or a niche in the market where it's too small for the developers to deal with and maybe a little bit too much for the mum and dad to deal with. So there's still opportunity to be seen in that market. So they're the sorts of things we look for. The other thing we look for is trying to create properties that are very attractive to all segments of the market, okay? So in the front, if we just flick back for a quick second, in that front house there, upstairs is your traditional Queenslander, okay? Beautiful, and as it sits right at this very moment, it is a 3-bedroom, beautiful Queenslander with a second living area. It's a lovely house. But with a single lock, that turns into 2 incomes. It turns into multi-generational living, or it turns into a family living upstairs with an Airbnb income downstairs. Okay? We've got the Olympic Games not too far away. It's a clever property, okay? And that's the sort of thing that we can do from your first-time investor buying a $400,000 property, your rent investor, through to, we're not going to do $46 million apartment blocks, I'll promise you that, okay? We've got enough grey hair as it is. But what we can do is create those opportunities, and our aim is to find the holes in the market to make your money work the best it can for you. Because the key to success is having an amazing team around you. I've made mistakes by having bad information, okay? And having an amazing team that can ensure that the decisions you make are right. What we saw before with the Wealth Club is amazing, but all you need to do is buy one wrong property and the handbrake gets ripped on very quickly, okay? Because if you don't have the fund the deposit to fund the next property, there is no next property. Okay, so having the right people in place to make sure that your strategies have longevity, knowing where you're going to go. It's like you walking out of here and getting in your car, starting it up and just starting to drive. You've got no idea where you're going. You've got no idea you're just going to run out of petrol and end up somewhere. But that's how most people spend their financial life. Okay, they just work, run around like a lunatic and wonder why they don't get anywhere. It's like driving your car with no destination. So to take that moment to sit down with people who care about you, find out what your destination is going to be, and you know what? You might not get there, but you'll get a hell of a lot closer. You might have a $500,000 a year passive income. Well, you might fail and end up with 450. Okay? But if you don't know where you're going, then you're never going to get there. Okay? And what my job as a buyer's agent to do is to find the right properties to enable you to achieve whatever goal it is that you want to achieve, and put you in the right places to ensure that we can release equity as quickly as humanly possible. We can reduce your cash flow output to ensure that your lending and serviceability is at its utmost. And that's what we specialise in. And it's really a very personalised situation, which is why it's kind of difficult to give general advice. But we've been fortunate enough to do things like this. Look, we've done these for other customers, by the way. I just don't show you theirs for privacy laws. But yeah, it's an amazing opportunity. And again, that is a return on investment of, I believe that there's no such thing as a bad property type. So that property returned me 175% return on investment. I don't advise this to everybody. Again, it depends on people's thing. But I bought a unit off the plan, okay, which is a risky thing to do, all right? But when you know what you're doing and you have evidence and data to back up the decision you're making, I bought a unit that has returned me 235% return on investment in the same time that this has. Okay.
Which again, people are saying don't ever buy units.
Exactly. And if I look at the stress this has caused me, and I manage these for people, so you guys don't have to worry about it. But let me tell you, there's a little bit of stress involved compared to the stress of the unit. Like,
I'll take
I can tell you, the grey hairs are from that, not from the unit. So And I'm not saying that they're not, but again, that's a matter of understanding what people's capabilities are and what their appetite for risk is, and that there's not just one thing that makes you money. And I just bought another property down in Melbourne today, which is fantastic, and thank you for funding it.
It's not that we don't recommend you buying in a trust in New South Wales. Again, it depends on your situation. But again, you can find states that you can sort of circumvent that and minimize your tax. So it's just the challenge in New South Wales is obviously you have an extra tax that you got to take into account when you're doing your decisions. But it doesn't mean like don't buy in a trust in New South Wales. It's just it can be a little bit more expensive. So make sure you're prepared for that. Any other?
Again, it's just having the information. By jumping states and borders, you can minimise your tax. So it's just a matter, but it's a matter of understanding. Again, if it's going to cost you $1,500, so for example, I just bought in Victoria. There's no tax-free threshold in Victoria anymore, so I'm going to be paying X amount of dollars in land tax from day one. But my data shows me that property is going to make me so much money in the next 4 to 5 years. The last thing I'm concerned about is land tax. It's important for me to know it, understand it, and put it into my figures and ensure it's not stopping me from doing what other things I want to do. But just as long as I know what it is, I understand it, and I'm prepared for it, and I can afford it, then in some instances, in some cases, for me, it's similar to LMI. Okay, I have had situations where a client needed, the only way they could purchase was LMI. And we sat down and we had a conversation. And we went through everything, and I gave all of the education, and they just said, look, do you want me to simplify it for you? And he said, yes. I said, if you gave me $20,000 and in 12 months' time I gave you $150,000, would you do it? And he said, yes. I said, well, that's kind of your answer, because you can't get the 150 unless you spend the 20. Okay? Now, I'm very confident with where I was putting him, and you mean there's a lot of data to back up what I was saying, and obviously I said there's absolutely no guarantees, but I'm very confident I'm putting my money there. And 100%, he ends up getting more than that. So, but again, it's just a matter of having the information and making the decision. If paying LMI sometimes is the only way for you to get into the property market and the time's right, then sometimes it's the right decision. But it's, yeah. You mean, obviously I'm treading on the lender's toes here.
No, not at all.
I might be in handcuffs again.
Yes.
What are your opinions on the fact that there could be a bubble in the Australian housing market?
Okay. A bubble in the Australian property market.
A bubble in the Australian property
Yeah, this is being recorded, so I'll probably look silly in 10 years' time. I don't think we're there. I think supply and demand, and John, I think that's more of a you question than a me question, but I had the mic, so I'm going for it.
Go for it.
I don't think we're there. I think supply and demand is still a challenge. I think the government are trying as much as they can to, I suppose, change that and sort of, encourage builders to build more, and they're changing regulations and do affordable housing and all that. But I think we're still a long way for it. That's one thing. I think our tax system is still very heavily focused on investment property in Australia, which, again, right or wrong. I'm always of the believer there's no right or wrong. Like, if you want to, you can sit on the sideline and just complain about it, or you can join and make a decision and use that to your advantage, and that's what most people do. I think we're far from it. I'm not saying it's never going to happen, because I can't be that person. But John, do you have any more, like, infrastructure?
Yeah. Look, I guess fundamentally what it comes down to is, I look at, again, I can only go from, this is my belief, okay? Looking back at data. I have a graph actually that I could have hijacked the entire night and given you so many slides and given you so much information, but I've got a graph that shows every time the media has predicted a catastrophic bubble or burst of the property market in Australia, okay, and what happens to property markets afterwards. We have very short memories in Australia. Probably the last one, if everybody remembers COVID, all of the experts came out and said the property market would crash by 30%. Okay, the bank, CBA, your favourite one. The bank said that, okay, and what happened to the property market? Okay, the property market was going to crash when we had the recession we had to have. The property market was going to crash when they were going to take away negative gearing. The property market was going to crash during the GFC. The property market was going to crash during the pandemic. The property market is always going to crash. I liken it to, there's only two ways. They need to try and slow the property market in some way. Okay, that's what they're concerned about, trying to make it affordable for Australians. There's only really two ways that I see that they can do that. One is interest rates and the other is fear. I much prefer the fear. It doesn't hurt me, okay? Because I'm educated and I do all the research and the data to overcome those things, so I still invest, okay? The interest rates hurt me because I borrow lots of money. So I much prefer the fear. So am I saying that no, there won't be a bubble? But what it does show is that buying in the right areas is important. So everybody wants to buy in Queensland right at the moment. 6 years ago, when I was telling everybody to buy in Queensland, everybody was calling me a lunatic because Queensland hadn't grown for 10 years and they knew somebody who bought a block 10 years ago and they sold it and they hadn't made a cent. Okay? Perth is the greatest city in the world at the moment. Prior to this bubble, it had negative growth for 11 years pretty much. Like negative, not flat. Okay? So why am I buying in Melbourne at the moment? We referenced a gentleman earlier, and it was Fabio, it was Warren Buffett, wasn't it? And one of his other famous sayings is, when the buyers are greedy, be wary. And when the buyers are wary, be greedy. And what that's saying is, why am I buying in Melbourne at the moment? Because most people are buying in Queensland now, because they'll listen to me. Okay? But if you're buying in Queensland at the moment, you're kind of buying towards the top of the market. Now, I'm not saying Queensland isn't a good buy at the moment. The reason being is because you've got the Olympic Games coming. Again, if you look at history, we had 7 years of double-digit capital growth in Sydney, 3 years before, year of, 3 years after. Okay? In the Olympics in 2000. Okay? So if history repeats itself, Brisbane has got more legs. I mean, if you look at some of the media at the moment, they're saying Brisbane could actually outperform Sydney and be the most expensive city in Australia. Okay? Now, do I believe that? Maybe, maybe not. But do I think that there's a bubble? It's supply versus demand. And fundamentally, we can't build enough properties at the moment. And the very first thing you learn in economics is supply versus demand. And while ever we have a greater supply than we have a demand, I can't see properties bursting. What I can see is us getting like England and Paris and New York and all that sort of thing, where owning your own home is just a dream. And there'll be share. Like you look at the Australians who go to England when they're young, there's 8 in a house because nobody can afford to rent the house by yourself. Do I see that sort of thing coming? One of the things we're looking at the moment is, I went to England to investigate HMO, which do you guys know what HMO is? So housing with multiple occupancy, because there's such a crisis over there, and especially in and around London, they create the homes, and what they do is they have all the bedrooms so they're lockable, and you've got your own little ensuite and a wardrobe, but everything else is communal, okay? And it's because of the housing crisis and affordability. And I went over to England and was investigating that in 2018-19. GFC sort of slowed that down a little bit, but we're now starting to see that become a realistic thing in the major cities in Australia. It's already quite popular in Sydney. There's already some big organisations investing into it. And I've started investigating it in certain pockets around Australia and major capital cities as well, because I see that being an amazing opportunity for not only myself, but a lot of our clients, because there's multiple streams of income. So the answer to the question is, I don't believe there's a bubble.